Hello and welcome to LiveSquawk's Market Talk. This is the weekly review and preview show that just gives you everything that's happened over the past 5 working days and to give you a little heads up as to what we have coming up over the course of the trading week. Today I'll be joined by Sam Cutler, Portfolio Manager at 333 Capital, and we'll have a look, as I said, at what has happened, what impact it will have on the markets, and also look at the upcoming events and market moving data and whatever else we need to. So before I do that, though, just a quick disclaimer here. Content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And we'll get straight into this because it's going to be a packed episode, really, considering everything that we've had and everything that we have this week. So we'll have a look at some of the headline stories, as I said, that we've had over the past week. US May employment report. Sam's going to go into a bit more detail about that because he sees some flags on that. It beat forecast for May. Trump gets his big, beautiful bill. That was passed narrowly, but passed nonetheless last week. We've heard on the trade front that Vietnam, the latest to agree a trade pact, and White House is promising a flurry of deals to come. And across the pond in Europe, we saw Eurozone inflation tick higher to match ECB targets. And there's some interesting research I've seen on that suggests we may now see our last ECB rate cut. That was all last week. Actually, over the weekend, just to give you a bit more context, we did see some news over the weekend I think is worth noting. OPEC Plus said to accelerate August output hike as the group is eyeing market share. China was set to retaliate an EU ban with medical device import curbs. It's another one of those headlines. We saw Japan real wages drop the most since 2023 as inflation outpaced pay. Some of these stories really feed into some of the market moves we've seen so far, but are likely to have a longer running effect. But more of that to come. First, let's take a quick look. Sam, firstly, let's say hello to Sam. Hello, Sam. How are you?
Hey, I'm doing good. How are you? Thanks for having me again.
No, always a pleasure and always insightful. We want to get into last week's data, and I know you've got some bones to pick through in terms of the job report, but a few other things as well. So we'll get into that. So, what was your view of last week's non-farm payroll?
Yeah, well, again, I think the headline numbers here are becoming pretty deceiving, especially under the surface. I know I talked about this last time with the household survey, but, coming into this print, you could tell the market was a little unsure. The distribution range, if you can look there at that first slide on that bell curve, we had an extremely, extremely wide distribution range. And I think the market was positioning for a little bit of a softer print. I mean, the Bloomberg Whisper number, which is pretty much a survey of people on Bloomberg, you can go in, kind of input your estimates. So you get a bunch of, traders, economists, everyone on Bloomberg kind of submitting their estimates, and it puts the median in. That was hovering around 110,000 job gains. And the morning of the print, it moved down to 96,000. So it seems like the market was expecting, a print under the consensus, and what happened, right? We got a pretty far right tail print there. I mean, it beat by a little bit, and there was even some revisions higher to the revisions higher to the previous number. But if we look kind of on the flip side of that, private payrolls had the opposite effect. They had kind of a left tail miss on that distribution with some smaller revisions lower as well. So again, we kind of see that discrepancy that we've been seeing between, kind of private sector and, the headline numbers here. But if we dig kind of under the surface, leading up to this print, if you look at kind of the higher frequency data, it was kind of suggesting the typical pre-summer job cuts, right, that you see in education, that they were going to be a little deeper this year. And this, in my opinion, was likely driven by uncertainty over government funding, right? seasonal hiring in the leisure and hospitality sector, which is typically the main driver of summer job gains, was expected to be kind of modest at best. And
Okay.
what we kind of got was kind of the complete polar opposite of that, right? Government jobs accounted for 73,000 of that headline print, which is the largest since March of 2024. And if you compare that to, the 3-month average, the 3-month average of government job gains is only 13,000, and the 6-month average is only 17,000. So that's a huge, huge beat. And out of those 73,000 jobs, 47,000 of those were on the state level. Okay. And 40,000 of that was in education. So we actually had job gains in education in a place where in a seasonal period where you normally see job cuts, we had, 40,000 jobs added in education. And then you saw another 33,000 of those on the local level, which 23,000 of those were in education. So
just help me out with this bit, because I knew when Musk was on the team, and we know he's definitely not on the team anymore. When he was on the team, they went after education and the education department particularly as well. What is this telling us about the Doge effect and just on the educational perspective?
So that's what's interesting, because if you look at federal was, I think, around negative 7,000.
7,000, yeah.
But with the Doge is federal. These job gains came on state and local level.
Okay.
So it's a really weird. So I don't think this is really a Doge effect.
Understood.
Which becomes very interesting to me.
Understood.
Because, if you look kind of at that last slide on the district on that kind of data series table there, right? In February of 25, when Elon was hot in the Doge, federal government was a loss of 13,000 jobs. In March, it was a loss of 11,000. April, a loss of 13,000. May, a loss of 25,000.
Okay.
Now, this month, only a loss of 7,000. But if you look at the state and local, pretty steady gains on the local throughout that whole time series. And the state still positive, but on the very low side, right? March, 1,000. April, 11,000. May, 7,000. And now 47,000 here. So I think that's a very noisy print. And it's kind of a one-off, and I would not expect something like that to continue. So I think in the following months, you could see kind of some give back in those areas, which leads into the next point of where I think the more important jobs lie in the cyclical jobs, right? Which are kind of anything ex-government, education, and health. Right. Those came in at 23,000, which is our lowest reading since the start of the year in January. And if you compare that to the 3-month average is sitting right around 50,000.
Gotcha.
So we almost split that in half.
So again, we're looking at this number, and you've got the unemployment rate analysis you put up here as well. Where do you see this labour market going? And look, we haven't got a crystal ball, but your best.
Yeah, and that's why I think just these headline numbers that they're so deceiving. Because even in this jobs report, there was a big increase in the average duration of unemployment as well. Over 27 weeks. There was a decent spike up in there. I think we're at 1.6 million workers now.
Okay.
So, and oftentimes when we see a large upshoot here, it happened, back in 01, in 08, briefly in 2020. Those coincide with kind of decent economic slowdowns. Now, I'm not saying that's the case here. Obviously, we're in a very different regime from a fiscal sense here, but I think it's just a lot of noise, and under the surface, there's a lot of weakness in the labor market, and the way this data runs could kind of be not really painting the clearest picture if you just look at the headline numbers, right? So if we look at the unemployment, right, that dropped down to 4.1. Everyone, consensus was kind of expecting a rise to 4.3. But again, we saw a decline in the labor force participation rate. So I've been thinking about this for a while, and it kind of leads you to believe that deportations, because of Trump's immigration policies, are kind of suppressing the unemployment rate. And we can kind of dive into a little analysis here by kind of breaking down the household survey. So if we look at the civilian labor force, that's declined by about 775,000 people over the last 2 months.
Okay.
The civilian non-institutional population is up around 388,000. The number of people not in the labor force is up 1.1 million, but the number of unemployed people is down 603,000. So what we basically have is job losers leaving the labor force. So I think we can attribute that to illegal immigration who previously responded as having a job, and now they're kind of fearful of working for deportation, so they're actually permanently out of the labor force. And if you translate this into data, it would show up in the data as a lower unemployment rate and a lower participation rate. And if you translate that into the real economy, because of that gain in the household of 775,000, at the margin, it actually narrows household income for those households.
Okay, and that again, this has got to be something that the Fed will have an eye on and are flagging, and that knock, like you said, the secondary effects of this tightening in immigration and the deportation element of things, and even if they haven't, I'm trying to read between I'm reading between the lines, but even if they haven't deported these people, the fact that they're fearful for work again reduces that, like you say, the household income. So again, the knock-on effect is going to be far more, or going to reverberate far more across the economy than maybe we're currently seeing.
Exactly. And you have to think that, the Fed is kind of aware of these too, and they're looking at this because, if you kind of understand how the unemployment rate metrics are calculated and the labor force and all that, I put a slide up of a couple of the formulas just in case anyone didn't know and is curious about them. Like the labor force is just the population times the participation rate. Unemployed is labor force minus the employed. And the unemployment rate is unemployed divided by the labor force times 100. So once you have these formulas, you can kind of sit there and run some analyses, right? So if we had the labor force participation rate back to where we started in 2025, or even in April at 62.6%, we'd currently be sitting at an unemployment rate of 4.6%.
Oh, wow.
So that's just putting the labor force back to where we were in April.
Yeah.
So all this is leading me to believe that the unemployment rate is, being, suppressed by the decline in labor force, which is attributed to, the immigration. So is the unemployment, is this healthy for the economy? I can argue the point that it's not.
I'm talking timelines now.
And
how quickly how soon do the Fed, in your opinion, try and get on top of this? Because the messaging at the moment for me is very, very much we're not doing anything, we're not going anywhere, we're waiting for this data to show itself. And like you say, this is all still relatively hidden. I mean, not from them. I'm sure they see this, they understand this, but they haven't started messaging any of this yet, from what I've read and heard.
No, I haven't heard too many people talking about this either. And I mean, I think if you do the scenario analysis and just run it to a median, let's say the labor force is at 62.5, that brings you to the Fed's year-end estimate. It sits at 4.46, so that 4.5 unemployment rate. So I don't know if maybe they weren't thinking that the immigration was going to have this much of an effect.
Well, also, I mean, there's the political element as well. We know Powell's been, we've had not only Trump, but other officials really steaming to Powell about politicizing monetary policy, and which is a bit rich, and turning it against the incumbent administration. So, I mean, it's a sensitive subject for them to deal with, and they have to be very careful how they pick the language they use in order to reflect what they're seeing. Again, I've read through a lot of Fed policymakers' comments of late, and I haven't really seen them emphasize anything about immigration. Obviously the labour market is important for them, but on the immigration side, they haven't really laboured the point, forgive the pun, on that front.
Yeah, and then I mean, from a political standpoint, it makes sense too, because if then The reason they're saying they're not cutting rates right now is because the jobs market is appearing steady and they don't know the trade policy, right? There's still uncertainty around the trade policy. They don't know the inflationary impacts. So for me, if they were to start talking, unemployment is, a little worse than the market suggests, then what then is their reason to be on hold? They're kind of feeding into Trump's narrative there that, okay, they should be cutting rates.
Okay.
So maybe there's a little political game there at play, but I mean, this isn't really too much new, because even if you look at post-pandemic, right, a lot of the growth in the labor supply has come from immigration. Native-born civilian labor force has been pretty muted, with most of the gains coming from immigration, and that's kind of switched up the labor demand versus labor supply, right? Like prior to 2020, labor demand was always running below labor supply, right? So you're in kind of a demand constrained labor market. And post this 2020 period, you're seeing supply less than demand. So and at the same time, you've seen that increase in immigrants into the labor force. So I think there's a lot at play here, and maybe this is just a regime. Like, this could be a regime shift for us. I don't have the answer for that, and if I did, I'm sure I could make a lot of money. But I really don't have a clear outlook on that. I'm just looking at these points and going, okay, there's either a big regime shift happening here, or something right now isn't clicking, and that eventually is going to come home to roost.
So from an inflationary perspective, then, as you say, because it would put more upward pressure on wages, lower supply of workers, those in work or those looking for work can then, demand higher wages. And so
look too, the average hourly earnings has come down.
Yeah.
So it's there's so many contradictions in here. It's just a really interesting time. I think it's very difficult to get a clean cut narrative on it. I think it's just being aware of these risks, being aware of these things. So if something does come, you're prepared for what could happen from that point on.
Yeah, and this is all we're trying to do, just trying to flag the signs as we see them, and the news as we see them, for people to make the most informed decisions they can about their investments and their trading days, really. So that's the best we can do on that front. You wanted to touch on the debt ceiling and the Treasury, and now we've had this big, beautiful bill passed, albeit narrowly.
Yeah, so I mean, that was honestly, that came as a surprise to me that they got it done so fast, and I think that kind of gives you a little hint that Trump is pretty much in control of what he's doing right now, right? Because I really did not expect this thing to get passed, prior.
And that's a good thing, isn't it? I mean, that's a good thing for policy. It's a good thing for direction. You don't want. It's a good thing for markets because it takes away that uncertainty.
Exactly, and that's what the markets aren't liking right now is uncertainty, and we've seen that. So now we're getting a little more certainty, so we can kind of make ticks in the pros and cons column for the economy, right? So this unemployment stuff, for me, this labor force, would be a tick in the cons section. There's parts of this big, beautiful bill that are definitely pro for the economy and could lead to, supporting the economy, a little economic boom. But there's also some market mechanics in here that could lead to a little bit of liquidity constraints, right? So kind of market funding implications. So if I'm not mistaken, I think in the bill, it included a 5 trillion debt ceiling increase. Right. So the TGA right now is right around 335 billion, right? And if we look,
just to explain that's the Treasury General account.
Yes, that's the Treasury General account that they use, for funding needs and stuff. And during 2023 and 2024, it averaged about 700 billion. So there's kind of refilling that. Plus, they need another 300 billion of extraordinary measures to repay from recent auction proceeds. So that's going to work out to about an extra 600 billion in auction volume fairly soon. So I think Besant's been pretty clear that he's going to kind of pull some Yellen tactics and keep it very bill heavy.
Yeah.
So this is obviously going to have some impacts in the rates market, right? We've seen recently U.S. Treasury curves kind of flattening, which has kind of been expected ahead of some of these issuances, right? Mm-hmm. And if they do go to replenish the TGA by mainly issuing bills, it seems as though the curve steepener trade right now is very crowded and likely to be offside from here. So I think you have a good chance to see much flatter Treasury curves from here if they do make this bill heavy. I mean, even if you just look at, the 2s 30s curve right here, right, sitting at around 97 basis points, and the 1-year forwards are sitting at 117. So the 1-year forward break even is 20 bips. So you could be in curve steepeners right now, and in 1 year's time, if it steepens 15 bips, you still lose 5 bips on your position because you didn't, surpass the forward rates.
Yeah.
So I think that is some constraints there. And obviously, if you look at the chart on the left there, that there is some correlation between filling up the TGA kind of acts as a liquidity withdrawal from the markets, while they drain the TGA is kind of injecting liquidity into markets. So there's been a huge steady bit in the market here. Mm-hmm. And so, yeah, I mean,
confounding some people out there who think the situation, as uncertain as it is, would leave people putting cash on the side, but it hasn't. We've seen, like you say, the equity market or the risk assets effectively find a new level.
Exactly, and you've seen kind of demand for upside. I mean, if you look at 3-month call skew in the S&P 500, I mean, where it's the highest it's been year to date, which tells you folks are reaching for upside in the market. And I think this also plays into what we've spoken about before with the market kind of putting the tariffs behind us. We've got some clarity. There's some time now, but now we're coming again to that deadline, July 9th, right? And I believe it's August 10th for China. And I believe Trump came out today saying he's going to send some letters to some nations, and the tariffs could range from 10 to 70%. So again, that's a huge range of distributions.
Yeah, just to give people a bit of a heads up. So he delays the tariff trigger to August the 1st. EU-Japan deals are still eluding the US at the moment, and they'll be tougher nuts to crack. He's also threatened 10% tariff on anti-American BRICS bloc. Okay, and we know they have, I don't think as a group, but individually, been a problem on the trade front for Trump, obviously Russia aside. But India's proved a bit of a stumbling block. Obviously, we know the China situation. Brazil, as a socialist nation, I think it leans towards getting better deals with their partners such as China and Russia, I think. So there are some issues with the BRICS on that front.
Yeah, absolutely. Yeah, look, I mean, I think it comes down to one thing you have to really think about is, we did have a little slowdown in economic data, right? There's no denying that. For a long period of time, there was a discrepancy between kind of the soft data and the hard data, right? I think it was right around the middle of March, you saw, the soft data, the surveys and stuff really start to roll over, right? Mm-hmm. And at the same time, the hard data kind of started to climb up. And then as the soft data kind of troughed, the hard data kind of plateaued. And in the recent months since the beginning of June, hard data has rolled over substantially.
Yeah.
Right? But I sit here and I ask myself, did this slowdown really just come from policy uncertainty? Right? So if we get policy clarity, is this going to, again, to counter my doom and gloom about jobs and employment and labor force, if we get policy clarity, is this going to lead to, economic strength as you look at some of these things that could really boost spending as well in this new bill, right? Like no tax on tips, no tax on overtime, right? That puts a lot of extra money into the consumer's pocket. And I really subscribe to the theory that, in recent years now, post-pandemic, equity returns are being driven by fiscal, right? And this bill, I think, allows for substantial fiscal, right? And Trump's policies here are really kind of changing a lot of aspects of the economy and the financial system, right? So, I mean, obviously the outcome completely uncertain, right? Mm-hmm. I think if we do roll over and the jobs, become a little more apparent in the headlines. The tariffs do kick in at, these rates. It eventually leads to a little bit of weaker growth. The economy could definitely be weaker, and the fiscal may not be able to, stimulate it enough. But if we do kind of skeeve by that with, limited tariff impact, this massive stimulus could, be really good for global economies. So this is kind of the balancing act I'm juggling right now. And, I'm a little uncertain. The markets have ran up. So, I think it's a prudent time. I'm pulling cash onto the sidelines right now to kind of, wait and see a little bit here. We're taking out some of our equity allocations and just raising a little bit of cash right now because I'm a little uncertain of where it goes. And when I can make a strong case for both sides, I kind of want to be like,
you have the money to take a swing.
Yeah, I want to kind of sit back and see what happens and get a little more information.
Okay, cool. I want to, because we're obviously near the end. So some of the key takeaways we have here. Labour market, NFP, and this is US centric, but this is the largest economy. An NFP print of 147, heavily distorted by government jobs. Again, potentially masking underlying weakness there, as you've alluded. The declining labour force participation, artificially lowering the unemployment rate to 4.1%. So again, more hidden issues there. I mean, it's part of your confliction, as you say. On the Treasury and debt side, the TGA refilling from 335 to some $700 billion acts as liquidity withdrawal from the markets. Again, I'm still ringing bells on that side, and then I expect some 600 billion in extra auction volume, likely bills heavy issuance. With, as you say, vol control funds providing steady bid at the moment.
I did
go to a little bit, just very briefly before we.
I'll touch on that because I think that's a pretty important aspect to the steady bid in the market right now, right? Because vol control funds, right? They base their allocations on realized volatility, right? On a 30-day and 90-day look back period, but they place more weight on recent days, as you can kind of see in that little chart there of weighted returns.
Sure.
In estimated weight of the moving average volatility. So the most recent days get a heavier weight. So we're at the time now where all that April vol from Liberation Day is coming out of the look back period. So these strategies are starting to allocate a decent amount back, right? Their vol control funds are very slow to buy back the market, but they're very, very quick to delever when realized vol spikes. So we saw them kind of reduce their exposure. If we look at, a 12% vol target fund, they were right around 70 in the 70th percentile, right? 70% equity exposure. Liberation Day, they dropped down to about, 27% exposure. And since then, they've been slowly building it back up, and they're about 50 in the 58th percentile right now. So if we kind of try to model their flows, we do see there's a lot of daily buying coming from these vol control funds. And if we look historically, typically when they get to the 95th percentile, it's usually prior to getting another kind of major vol spike. So I kind of put that chart there that breaks down some of the larger daily buying flows of these vol control funds, right? You can see on the far right side, the realized volatility that's calculated. So as it drops, they have bigger buys to do. And so barring any headline vol spike here, which could happen because of all this tariff stuff going on right now again, I'm leaning a little bit that I want to be a little short equities here from a tactical standpoint, but I think it's very, very hard to be short prior to that August 20th date because you have such a steady bid from these vol control funds. So that last day, if you look at their equity weight on August 20th, they're back again almost to that 95th percentile. So I think from just a tactical trading standpoint, that's going to open up an area of a little bit of weakness for us. So if you couple the vol control funds drying up around then, that's right around the next monthly OPEX. We are going to have that replenishing of the TGA. Could be withdrawing some liquidity from the system.
OPEX, just the option expiry is just for those are not familiar with the language. So
I think that kind of sets up a potential place for a correction in area of weakness here, which is one of the reasons why I'm starting to pull back from equities right now. I think its valuations are a little rich from here. I could be wrong. We could continue to grind higher. Economy could continue to chug along for the reasons we stated. But I think there is an area here that we could see some weakness coming here.
Yeah, but also if there is a slight slowing and any more impact that they see from the labor within the labor market, I'm pretty sure they'll step on the gas again. And if you read between the lines, you have to read that hard between the lines of a Wall Street Journal's Nick Timiraos, he kind of suggested that Fed officials were maybe keener than they're letting on to potentially to move rates sooner than later.
Yeah.
So it's an interesting dynamic.
If you get another, benign inflation reading here, maybe you do cut in September, right? It gives you the room to cut in September, then maybe cut in December again, right? If this inflation reading picks up, maybe it keeps them off September and they only cut in December, right? But if you look at, the market right now, there's still 5 bips missing from the September cut. So, I mean, if we do get a benign inflation reading, hey, what that does kind of support. So that, there's a possible trade there to, kind of receive that September meeting and try to make 5 bips on it. If the inflation comes in benign, I think that gives them a reason to cut.
Yeah, fair enough. That leads us sweetly on to the week ahead. And just to quickly go over this, you can find all the details of what we deem the important events and data-driven occasions across the week on the focus on the week ahead on the LiveSquawk website. We'll put the link out there anyway with that. But just we'll get the FOMC minutes this coming Wednesday, which should provide a bit more color as to the Fed's thinking. It hasn't really changed. I mean, I've got a note here from TD Securities that said the FOMC minutes were likely to highlight uncertainty around the outlook and wide-ranging policy expectations. Fed speak after the meeting saw both dovish and hawkish comments. We could see a couple of participants highlight the potential for cuts in July, while more might note that rates could stay on hold for longer. The minutes are unlikely to expand on post-meeting Fed speak, noted the bank, though. And that's like you say, at the moment they want to try and stay neutral, but if you read between the lines and the bit of the language, they seem to lean towards a cut be the next move. Should that be the case, as opposed to anything else? Just quickly, we've got obviously all the political stuff with the trade deals. We have to be wary of all that. We've got tomorrow an RBA or overnight RBA July interest rate decision. There are expectations of a 25 basis point cut for there. We'll have on Wednesday mainland China's CPI. Experts at HSBC estimate CPI inflation to edge up to flat in June, driven by a low base and rising oil prices. I mentioned OPEC and potentially wanting to try and do more there. You've got an RBNZ rate decision. That's the Reserve Bank of New Zealand. They're expected to keep rates on hold at 3.25% this week. And it's quite a week for data on the whole. A few survey estimates coming through, but not a great deal on that front. And then Friday, you've got UK's May GDP read. And economists at Darwin note that the April's larger than expected drop of minus 0.3% marked a disappointing outturn for the start of Q2. Bank analysts posited that the decline was largely expected, owing not least to the strength of growth in Q1 due to temporary special factors. But now look for an insipid rebound of such, I suppose, of 0.1%. We'll also get Canadian labour force survey out on the Friday as well. In terms of speakers, again, it's a quieter week generally. As we start getting into summer months, we do start to see officials take their holidays. And so therefore, we're looking at a few ECB speakers throughout the scattering across the week. Tomorrow, the Office for Budget Responsibility will release its fiscal risk and sustainability report. And then then on the Thursday, Bank of England will publish its financial stability report, followed by a press conference with Governor Andrew Bailey. So keep an ear out for that as well. Any other points you want to make about the coming week? As you said, you're taking a bit of cash out, putting it on the sidelines. Will anything this week turn your head, again, with the trade discussions ongoing? Anything you're looking out for particularly this week? Sam?
No, it's pretty quiet. I think a lot of focus is going to be on some of these, the trade talks with Besant this morning too, saying his inbox is full of trade deals. So, again, just looking to see if any of those materialize. Like you said on the FOMC, I don't think there's going to be too much there, right? The only point I want to reiterate on the FOMC is to remember that they were only one vote away from being 125 bips cut in 25. And over the weekend, I believe Powell spoke, or maybe it was last week. And he said that if it wasn't for tariffs, they would have lowered the policy rate already. So you kind of have to think that causes an effective tightening still in the market.
Sure.
So I just want to throw that out there that, again, I think that goes into our talk about the inflation. If inflation comes in benign, it could set up the cut in September. And I think that would match their 2 dots. But, everything for them, the Fed right now, I believe, is it's all inflation and trade policy. We need a little bit of clarity on that. And there's a possibility that, you don't really get the full read through of inflation from tariffs until October.
Okay. So yeah, I mean, and then it's all hands to the pump, really, I guess, on that front. I think the earnings season is coming up soon as well, so we'll see what the corporates start to think. But thank you, Sam, for your input today. It was again enlightening as ever.
Always a pleasure.